Hey friends, welcome back to Wealth for You, the channel that helps you grow passive income without growing stress. Today we're answering one hot question that's on every income investor's mind. Is it finally time to invest in the CFA REIT ETF? Yes, the one that pays you dividends every quarter and currently yields around 6%. If this video helps you, give it a like so more Singaporeans can learn about this powerful REIT ETF. Also, hit subscribe to support this channel, Wealth for You. And stay till the end, because I'll also share how the coming Fed rate cuts could be a game changer for your dividend strategy. Disclaimer: this video is for educational and informational purposes only. It does not constitute financial advice. Please always do your own due diligence, and consult a licensed financial advisor before making any investment decisions. Part 1. What is a REIT ETF? In Singapore, we love REITs, short for Real Estate Investment Trusts. They let you invest in shopping malls, office buildings, warehouses, all without the hassle of actually owning and managing physical property. It's like collecting rental income without becoming a landlord. But instead of picking and choosing one REIT at a time, you can go one step smarter. Invest in a REIT ETF. Think of it like economic chai fun. Instead of just chicken wing or fish cake, you get a bit of everything on one plate. Balanced, diversified, and less risky. Now, the REIT ETF we're talking about is called CFA, not the finance exam. It stands for the NikkoAM-StraitsTrading Asia x Japan REIT ETF. And what does it do? It's like one big basket holding more than 40 REITs from across Asia. Shopping centers in Hong Kong, warehouses in Singapore, offices in South Korea. But no Japan REITs inside, because those usually give lower yields. So if you want steady income, exposure to regional real estate, and instant diversification, this REIT ETF is a very decent starting point. Let's dive in deeper. Part 2. Introducing the CFA ETF. So, what exactly do you get when you buy into the CFA REIT ETF? Well, imagine opening up that diversified chai fun plate we talked about earlier. And here's what's inside the mix. Right at the top, we've got some of Asia's heavyweight REITs. Link REIT. That's Hong Kong's biggest mall owner. Think massive retail spaces in prime locations. Then there's CapitaLand Ascendas REIT, Singapore's champion in business parks, logistics, and tech hubs. CapitaLand Integrated Commercial Trust, or CICT, is another Singapore giant that owns places like Raffles City and Funan. Over in India, we have Embassy Office Parks, one of the biggest office REITs in the country. And of course, there's Mapletree Industrial Trust, or MIT, great exposure to data centers and modern industrial spaces. Altogether, this ETF gives you around 70% in Singapore REITs. That's our home base. And the rest spread across Hong Kong, India, Korea, Malaysia, and Thailand. But it's not just about geography. It's also about sector exposure. Here's the breakdown. About 33% is in retail. Shopping malls and commercial centers. 27% goes into industrial spaces, warehouses, logistics, business parks. 15% in office properties, 5% in data centers, which is a growing theme globally, and 4% in hotels and hospitality. So you're not betting on just one country or one type of property. You're getting a well-balanced property spread across Asia, with the strength of Singapore REITs anchoring the whole portfolio. Pretty neat, right? Part 3. Is CFA undervalued? Now here comes the juicy part that every investor wants to know. Is CFA undervalued? Is it a bargain? Let's look at the numbers. The CFA REIT ETF used to trade at $1.30 back in 2019. Before the world got flipped upside down by interest rate hikes and global uncertainty. Fast forward to today, and it's trading at just around 79 cents. That's a whopping 42% drop from its peak. For a basket of income-generating property assets, That's pretty significant. But here's where it gets interesting. Across the region, many REITs inside the ETF are now trading at around 0.8 times book value, which means the market is pricing them 20% below what their assets are worth on paper. And guess what? Recently, we saw some REITs being taken private at full book value, like Paragon REIT, which was privatized at 1.0 times its NAV. So if investors are willing to pay full price in private deals, but the ETF is still trading at a 20% discount, is this a buying opportunity? You might be looking at a REIT buffet at clearance prices, with the strong Singapore dollar and regional property backing it. But hey, we're not here to give advice. You decide. Just remember, discounts don't last forever. Part 4. Dividends. So what's the main reason income investors are still holding on to CFA? 2 words: quarterly dividends. Yes, 4 times a year, just like your copy breaks. Steady and reliable. At today's price of around 79 cents, the dividend yield works out to about 6% annually. That's roughly 4.6 cents per unit each year. Not too shabby for a diversified REIT portfolio. But here's the part that might surprise you. Even though the price dropped over the past few years due to interest rate hikes, the ETF kept paying dividends. No drama, no missed payouts. Just regular distributions like MRT trains on a Sunday morning. Maybe not glamorous, but consistently on track. For long-term investors who value passive income, this kind of stability is gold. Part 5. How Fed rates affect REITs. All right, here's the tough love part. REITs and interest rates, they really have a love-hate relationship. Whenever the U.S. Federal Reserve raises interest rates, a few things happen. First, REITs have to pay more to borrow money. And you know, REITs rely on loans to buy buildings, malls, offices, warehouses, all that. So when borrowing costs go up, their profit margins get squeezed. Less profit just means, well, less attractive. Second, investors want better returns. If so-called safe assets like U.S. Treasuries start offering 5%, people expect REITs to give even more. So REIT prices have to drop in order to offer a more competitive yield. That's exactly why in the past 2 years, when the Fed aggressively raised rates, REIT prices and even ETFs like CFA dropped. But hey, here's some good news. We might finally be seeing the end of the rate hike cycle, and that could mean borrowing costs stabilize or even fall. REITs might regain investor interest, and prices could start recovering. So in short, less pain, more gain? Stay tuned. Part 6. Rate cut in July 2025. Now here's something that's got investors buzzing. There's growing chatter that the U.S. Federal Reserve might cut interest rates as early as July 2025. Why? Well, inflation is cooling, growth is slowing down in some economies, and even Mr. Trump is back at it again, calling the Fed chair terrible. Say what you want about politics, but market drama? It's never boring, right? So, what does a rate cut mean for you as an investor in REITs or the CFA ETF? Let's break it down. Borrowing costs for REITs will drop, making it cheaper for them to expand, refinance loans, or improve yields. REIT prices tend to go up because lower interest rates mean higher investor demand for yield-generating assets. The CFA ETF could rise in value, especially since it's been beaten down the past couple of years. Dividends? They'll likely stay steady, and could even grow later as REIT earnings improve. So if you've been waiting for a better environment for REITs, keep your eye on the July 2025 Fed meeting. That could really be the turning point. Part 7. So, is it a good time to buy CFA? All right. Now that we've looked at all the moving parts, let's bring it all home. If you're a Singapore income investor, here's the big picture. You're getting a diversified portfolio. Over 40 REITs across Asia, not just Singapore, but Hong Kong, India, Korea, and more. And honestly, many of these REITs are pretty solid names. The dividend yield is around 6%, paid quarterly. That's like Kopi money flowing in regularly. The price? Still down 42% from its 2019 peak, which means you might be picking this up at a real discount. And if rate cuts really do come in 2025, we could see some upside in price as REIT sentiment improves. But here's the honest truth. It's not risk-free. If recession fears return or markets get spooked again, prices might dip further. So if you can't tahan or handle the ups and downs in the short term, maybe just wait it out a bit longer. But for those of you who are long-term income seekers, looking for passive cash flow and a stable entry point, CFA at under 80 cents is starting to look like a pretty steady long-term buy. Personally, I'm DCAing, just buying a little bit each month. No stress, no FOMO. Just sit back, sip Kopi, and let the dividends drop like clockwork. So, will you be investing in the CFA REIT ETF? Let me know your thoughts in the comments. I always love hearing from you. And if you found this video helpful, hit that like button, subscribe to Wealth for You, and tap the notification bell, so more Singaporeans can learn how to grow their money and build true wealth, not just chase hype. Because at the end of the day, it's not about being rich on paper. It's about being cash flow rich, with real income that gives you real choices in life. Here on Wealth for You, we help you turn your dollars into cents, the Singaporean way. Till next time, invest smart, live well, and take care. Bye-bye.